Banks are doing a variety of things in today's market to maximize their revenues. And if you see the marketplace, it's dominated by the big banks, and the bigger banks are gaining market share. Some of the smaller banks are getting weeded out, and some new entrants are coming in and gaining market share. The things and the strategies that they're doing to maximize their revenues is to build a good quality book by having a very focused approach on who they target from their customer standpoint, and designing the products that address this targetable market, whether it is in footprint, where they have branch networks, or whether outside footprint, where they have a direct to customer strategy. So having a quality product that addresses this market segment is helping them gain market share. The second thing that they're doing to capture market share and thereby maximizing revenues is having good quality of origination, thereby increasing the average gain on sale of an asset if they're selling the asset into the marketplace, or the net yield spread if they're holding it on portfolio. By originating good quality products, you can have a higher amount of spread between the price that you pay into the market and the cost of originating the mortgage. When they're going to maximize revenues, the biggest mistake that banks make in trying to build a bigger book is not having a well-defined strategy on what kind of product you're selling, whom you're selling to, and how you're going about it. And in the rush to build a big size book, sometimes underwriting standards can be relaxed, sometimes they can be twisted, sometimes they can be waived for certain conditions. That is a short-term measure which can design and get some short-term gains, but ultimately you're exposing yourself to repurchase risk if at some point in time the mortgage results in a delinquency and it goes back through the repurchase cycle and comes back to you. So being very tight on your underwriting standards and having a very tight processing cycle is very key to minimizing the risk and the mistakes that you can make in this. The second mistake that banks are making is having such a broad reach that they build a significant pipeline that they cannot handle. So they don't have the capacity to manage the pipeline that they're building, and that results in unhappy customers, delays in time to closure, and increased costs of origination, ultimately affecting their bottom line. So these are the two big mistakes that we see in the marketplace that banks are making that is working against their strategies. There are several opportunities in this area to maximize your mortgage revenues and improve your product profitability. One is by having a nationwide strategy, if that is part of your business plan. If you don't want to go nationwide and want to only originate in footprint, then the second thing is to have a very focused strategy across the multiple channels. Design your channels well and go after those channels, whether it is a retail or a direct-to-customer channel or a branch channel or a wholesale channel or a correspondent channel. You need to have a well-defined execution strategy for targeting your customers correctly with the right product and originating at the right price points, and then making sure that you continue to originate a good quality book that meets underwriting standards that you can sell into the marketplace or hold on your portfolio. The market is a very, very interesting market right now, and we are in an extended period of interest rates being where they are historically low, which is fueling a lot of refinance related mortgage transactions. This party is expected to last probably maybe a few months, maybe a year and a half, but at some point the music's going to stop and the market's going to dry out. At that point, how mortgage originators and mortgage banks react to it is going to be less relevant as compared to what they do today to manage their risk down the line when the party stops. And a combination of having a base load volume done in-house and a peak load volume kind of outsourced or managed with third party or through channels which can be turned off, like your correspondent to the wholesale channel, is one approach. The second approach is to prepare yourself for the purchase behavior and the purchase marketplace that's going to come up. Right now it's refi, 75% of the market is refis and less than 20-25% is purchase. But that's going to change. The market size will shrink from 1.8 trillion to maybe 1.2, 1.4 trillion, but the purchase is going to pick up, and therefore are your products designed for capturing the market share in the purchase market is also going to be key. Right now, most of the products are designed to capture the refinance market share, and very few lenders have focused on the purchase product. But some of them are thinking about the future and designing products to capture that market share, and being more aggressive on the branch channel marketing as well as the direct-to-customer marketing, such that when the party stops and the interest rates rise, as is likely to happen, they have a good handle on where are the new mortgage transactions coming from, where are the people buying, and are they targeting those customers well.